I think we're in a caffeine bubble. That's what I tweeted about a week ago. And I'm not sure if the Wall Street Journal reads my Twitter, but they just recently came out with a very similar take. They have a headline story here saying that the fast food industry wants to be the fast drinks industry too. There is a seismic shift happening with food and beverage sales. And this article details it out. They go through all the different examples, but I have many more as well. People are addicted to caffeine. We see an increase in caffeine drinkers, younger and younger, even high schoolers drinking tons of caffeine now. And this has caused a lot of different companies to get into this game. But it's getting to a point now where, again, I start to believe we're getting into bubble territory. So we're going to be looking at possible opportunities and companies that we may want to avoid. We'll be going over this entire theory of mine in this episode. Now, we also have some other news to get to. We know the market has been on a winning streak. This year has been good for most investors. We have a lot of people excited about the New Year's. We have the Santa rally coming into play. And we have also, right now, the Fear and Greed Index moving into the extreme greed category. This is where we get to the highest levels of greed in the market. We're going to be looking at our portfolios and trying to determine what is the best course of action when people start getting greedy, when investors start getting a bit lazy and we just get more buying and buying and buying. So I'll be looking over my portfolio. I'll be showing you what I'm doing with it. And then we have another piece of news I want to cover today. This is the story of retail crime. We know a lot of retailers like Target and Walmart have blamed an increase in crime and violence as a reason for them closing their stores. In fact, Target blamed theft and violence for 9 store closures. CNBC did an investigative look at this and said that the crime is actually higher at locations they kept open. From CNBC's actual conclusions here, they say that the findings cast doubt on Target's explanation of the store closures and raise questions about whether the company's announcement was designed to advance legislative agenda or obscure poor performance, poor financial performance. So CNBC basically is accusing Target of lying about the reasons they closed the stores and using it as an excuse for really poor financial performance. So we'll be looking over this report and I'll be highlighting why this CNBC report is incredibly misleading, why it doesn't cast any doubt on what Target is saying, and how this report and investigation in and of itself is entirely inconclusive. So we'll be going over all of that. Obviously, we have a lot to get to. If you like this type of content, make sure you subscribe to the channel and ring that bell to get notifications for whenever I upload. Now, I first want to start off by addressing this caffeine bubble theory. My theory is that I believe caffeine is getting into bubble territory. Bubble meaning that a lot of companies with a lot of capital are chasing consumers into serving highly caffeinated beverages. Now, I don't know about you, but I've been inundated almost every single day with more and more news of highly caffeinated beverages. Some of the more unfortunate news recently are 2 deaths linked to the charged lemonade from Panera Bread. Part of the problem is you wouldn't expect a company like Panera Bread to serve a lemonade that has 400 milligrams of caffeine, but they did because they know that people are becoming addicted to caffeine. And in fact, increasingly, more and more people are becoming addicted to caffeine. There's new trends now that even high schoolers are becoming highly addicted to caffeine, spending upwards of hundreds of dollars per month on caffeinated beverages. And this has led to a race to fulfill consumers' insatiable desire of consuming greater and greater amounts of caffeine. We have the fast food industry that wants to be the fast drinks industry. And they go over a lot of the benefits of this change for companies and how it's affecting consumers. Ice drinks topped with cold foam and added energy shots and fruit flavors have hooked high school students, social media influencers, and now some of the biggest fast food chains. McDonald's this month launched Cosmics, a new takeout-oriented restaurant concept heavy on customizable drinks like churro frappes and pomegranate hibiscus slush. So we know Cosmics, we've looked at the menu. It is almost a copycat of Dutch Bros or Starbucks. It's somewhere in between there. But that's not where this ends. We have more and more big fast food chains going into this category. Taco Bell in December started testing blended iced coffee with flavors like Mexican chocolate, along with shakes topped with cold foam and churro crumbles. Jack in the Box boasted that it is one of the first fast food chains to serve drinks with tapioca pearls and boba, with national launch in November. So we have, just to be clear here, we have McDonald's going into these type of customizable drinks. We have Taco Bell going into it. We have Jack in the Box going into it. So every major fast food chain is going into this. And we know Panera Bread has gone into it as well. Chains that are known for burgers and burritos have set their sights on consumers' willingness to spend on what goes in their cups, which can be more lucrative than fast food. That is a key thing here. A lot of the fast food industry is low margin. That's a big problem with it. The unit cost structure is difficult. The constant training and turning over of employees is difficult. And the input cost, the commodity cost of buying beef, buying chicken, fluctuates and makes it very difficult to price fast food. But with drinks, it's different. You only need a few simple ingredients, they're super cheap, and you can charge quite a bit for them. Pink Drink, iced shaken espresso, and other novelty beverages have helped deliver record sales for Starbucks. Starbucks is the king of this entire industry. In recent years, with syrups, foams, and other drink additions generating $1 billion in US sales alone. And this is accurate. If you look at the Starbucks app, the level of customization literally has thousands of options almost per item, the amount of different options that you can do. So they have the customization game down, but there's a lot of competitors now going for that king, which is Starbucks. Dutch Bros, 7Brew, and other new chains are also riding the beverage wave, with cold brew and vibrant colored energy drinks, along with higher profit margins than many fast food chains. I'll mention that there's a lot of other local companies doing this as well. Little fast food chains that don't show up as big as Dutch Bros because they're not publicly traded. And this big dynamic change is primarily being driven by Gen Z. Gen Z, typically defined as those born between 1997 and 2012, are more interested in the new drinks than any other generations, according to company surveys. An estimated 62% of Gen Z consumers reported trying new beverages in the past month. So half of this entire massive group of people, an entire generation of people, over half of them have tried a new beverage in the past 30 days. That right there, I believe, has some interesting implications on consumer staples. We know that the entire investment thesis of companies like Coca-Cola is their massive distribution, their low capex, and people being addicted to the brand, valuing the brand Coca-Cola. But what I see here is a generation that has no brand alliance. This isn't a generation that's addicted to Diet Coke, that drinks the same drink every single day with no variance. They want change. They want something exciting. They see something on TikTok. They see someone come up with a new drink concoction and they want to drink it themselves. So we're seeing a generation that is far more flexible in what they're willing to try in terms of their beverages. And I do think that again has implications on companies like Pepsi and Coca-Cola. They mention here that a lot of this is being driven by social media. Gen Z consumers, now numbering in the tens of millions, have powered drink trends by posting brightly hued beverages on TikTok, and many consider the drinks a daily must-have. The caffeine obsession has taken hold. Now when Gen Z, and I'll add many millennials, when they wake up, one of their favorite and most important decisions to them of what they're going to do with their day, one of the first ones is what drink they're going to have to accompany them throughout the day, to give them energy to accomplish the tasks needed. That's the role that caffeine's taking place. It is a daily must-have. It's easy to form an obsession with these drinks. This is from Sophia, a 15-year-old student from Atlanta who visits Starbucks, Dunkin', and other chains roughly 5 times a week for drinks and snacks. Her habit costs her around $240 a month. These chain restaurants have got me in quite a chokehold. So at $240 a month for one 15-year-old, you can imagine the size of this market. Think about the lifetime value. This one person, Sophia, her lifetime value to these companies is in the tens of thousands, 20s of thousands. She's going to be paying them a fortune. Consider the fact that a Netflix membership costs Sophia maybe $7 a month, so you're paying $100 a year for a Netflix membership. She's giving these companies $240 per month, well over $2,000 per year. And that's as a 15-year-old student who can probably barely afford this, right? She's in high school, she's using mom and dad's money or working a part-time job, so that $240 a month is a big issue. When she gets older, that's no longer a big issue. When you have a grown-up job, you can afford the $200 a month. So what we have here are consumers that are getting hooked early, and they're staying as lifelong customers of any type of caffeinated beverage. The issue for these companies is that they don't seem to be typically loyal to one brand. She goes to different chains, Starbucks and Dunkin' and other chains. So they're trying out a lot of different drinks. But the money's there. The money's flowing from these consumers to these companies. Now they move on and highlight something I think very interesting here. Here's a quote from the Smoothie King CEO. Younger people are really into these beverages. They're moving away from soda and finding alternatives in other sectors. Again, this is the Smoothie King CEO that apparently runs 1,300 unit beverage chain. So this is just a beverage chain that has 1,300 units. That is incredible. I've never even heard of or gone to Smoothie King before, but it's a massive chain. So you have so much capital moving into this category. So many different chains and restaurants and fast food companies and private companies offering highly caffeinated beverages in all different shapes and sizes. And young people are buying this up, moving a lot of their money, their monthly budget into these drinks. That's great for these companies that are growing these giant beverage chains, but they highlight another concerning trend for other companies like Pepsi and Coca-Cola. This generation is moving away from soda, from the soft drinks. They don't have as much of an interest in buying the Diet Coke as they do the brightly flavored plastic cup drink they get from one of these locations. Now, I've seen a lot of data around this as well. Some of the best performing companies in the world over the past 10 years have been energy drink companies, Monster Beverage being one of them. Monster Beverage is a massive $57 billion market cap company. And Monster Beverage's revenue looks like this. On an annual basis, this is what it looks like. It's gone up 10x over the past 15 years, from revenue of $180 million to now revenue of over $6 billion. So they've grown massively. This is an energy drink company. We have another company that is in the spotlight right now, Celsius. This is one that likewise is growing like crazy. If we look at this one on a quarterly basis, you can see the exponential growth of this company. It went from having revenues of only 30 million, so it's just a tiny unknown company, and now it's grown those revenues over 10 times. So over an entire order of magnitude up to $384 million in a single quarter. So on an annual basis, this company is going to be doing over $1 billion in revenue. And it's accomplished this just over the past couple of years, since around COVID to current day. We compare this with Coca-Cola, and of course, they're not seeing anywhere close to this type of revenue growth. It's flattish or up or down a little bit year over year. The past couple of years, I guess they've grown 14%. That's mostly due to restaurants opening back up where they get a lot of their licensed revenue. We also have Pepsi, which is not growing quite as fast either. Now, a lot of this is obfuscated by their Frito-Lay investment. Over half of the revenue from Pepsi comes from food and snacks, but the Pepsi drinks are not growing at the same pace as Monster Energy or Celsius, that's for sure. So we can see clearly what's growing right now are specialty drinks provided by chains, fast food restaurants, and energy drinks. Energy drinks are still growing quickly. What's not growing are soft drinks, sodas, your basic Coca-Cola or Pepsi. Those sales have been very sluggish and very flat overall. The demand for these specialty drinks is ever growing. They mentioned that it's growing faster than most fast food restaurants. In fact, the beverage and snack chains specifically grew at 14% in 2022 compared with the year prior, and those at coffee shops increased 13%. By contrast, burgers delivered higher sales overall last year, but they grew by only 4.7%. So specialty beverages are growing at a much faster clip than burgers. So there we have a look at the gold rush into this caffeine market, which is all part of my caffeine bubble thesis. Ultimately, what I believe is that there's too much capital, too many companies chasing into the same market, and there's going to be a few winners and a lot of losers. The way that I would look at it or compare it to is the craft beer bubble. Remember when craft beer companies were popping up everywhere? Local breweries and mass breweries? This was the thing. This is what everybody wanted to do. There was so much capital chasing into this category. And now it's not only gone flat, it's gone down. It's going down steadily. The craft beer industry had the problem of too many companies, too much capital, all chasing for the same consumer dollar. And I see the very same trends here. I think there's going to be a few winners and a lot of losers. I think the energy drink companies will be fine. Celsius and Monster Energy, they already have a very established consumer and distribution, very loyal customers. But I believe a lot of these new caffeine chains are going to struggle as more fast food companies make their way into this category. Companies like Burger King or Taco Bell or McDonald's can add these highly caffeinated beverages to their menu and offer significant upside for their company with little downside. If people don't buy it, that's fine. They continue selling burritos and tacos. But if people do buy these new caffeinated beverages, then they have higher margins on those sales. I also believe this dynamic trend shift is going to put further pressure on Pepsi and Coca-Cola. They primarily rely on soft drink sales, not energy, and they have been slow to move to energy. So while they've done well historically with soft drinks, I think this is going to limit their future growth, and they may not do quite as well in the future. But overall, this entire category of caffeinated beverages is feeling a bit bubbly. For that reason, I'm staying out. Now moving on, we have to jump into how the market is behaving recently. We have right here from CNN a fear and greed index. And what this does is they take a lot of momentum averages and metrics to determine if investors are acting with extreme fear or extreme greed or somewhere more neutral. Right now, this is shifted firmly in the extreme greed category. It just means that investors are buying up stocks. Their prices are going higher. Investors continue to buy even after prices go higher. This is typically driven by strong market momentum, strong amounts of greed, and very positive sentiment in the market. Now, a big question is, what do we do as investors in this situation? Let me go over what I do in these situations, because I've been in them before. We can look at my portfolio, and I'll go over that, but I first want to just go to this drawing right here. I've drawn something like this similarly, but I think this explains it really well. This black line, for example, is my drawing of the intrinsic value of the market. Over time, the intrinsic value of the market goes up based on cash flows per share improving, free cash flow per share, earnings per share, EBITDA, revenue per share, based on increased dividends and increased buybacks. So as companies produce more cash, as they buy back their shares, as they increase their dividends, the intrinsic value of the market as a whole goes up, or any individual company as well, typically. But the price does not behave this way. It doesn't go up smoothly like the intrinsic value of stocks. The price behaves more like this. It goes way above, it goes below, in some cases it goes way above and it goes below. The price moves around with far more volatility than the actual intrinsic value. So as a value investor, which means that you're focused on the intrinsic value of the asset you're buying, you're supposed to be focused on this black line, while the price metric makes you focused on this orange line. And that can be very confusing and difficult. Right now, I believe we're in a situation like this. The price has gone up here and the intrinsic value is down here. The price in essence is going up much faster than the intrinsic value. And that typically comes down. They come closer together over time. At some point in the future, the price will get closer to the intrinsic value. So we have a couple different options of what we can do. A lot of investors will try to sell out right here and buy right here when the price goes back below the intrinsic value. More often than not, when investors try to time the market this way, they end up selling right here. Sure, they sell a little bit above, but then the market continues to race up big time. And then they end up buying back in right here, missing the gains in between and setting themselves up for further failure when the market inevitably goes down. This is where it gets really tricky. You can't, with precision, buy in and sell out at the perfect time. So in my case, what I try to do instead, which I think is a better route, my strategy at times like this is to do something that requires discipline and patience, is to simply sit and wait. To just do nothing, to just let this work out. The companies that I own, I believe on an individual basis are undervalued based on their next 10 years of growth. So I think I own great assets that are generally undervalued, but prices have gone up rapidly. There's a lot of investor enthusiasm. And in times like this, I simply just sit and wait. I don't like selling out because that's trying to time the future. I don't like buying in more right now because I feel like, again, things are a little bit ahead of themselves. So I believe the best option is to do nothing. So let me know what your strategy is today. If you're buying into this momentum, if you're selling, or if you're doing what I'm doing and just sitting and waiting. Now moving on, I want to address this report that took aim at Target. Target blamed theft and violence for 9 store closures, but this CNBC report and this investigation found that crime is higher at locations it kept open nearby. So what they're saying here, what CNBC is not so discreetly saying, is they're trying to discredit Target. saying that they're really trying to cover for poor financial results, and that's the reason they're blaming it on violence in stores. In fact, we can just go ahead and let them explain it themselves.
If Target was trying to prioritize worker and, customer safety, they would have closed the stores that are still open. What my investigation found is that the stores that Target chose to keep open in nearby locations actually had way higher crime incidents than the ones that they closed. So what we did is I pulled public records from all the police departments that saw store closures. That was going to be in Seattle, Portland, New York City, and San Francisco Bay Area. And so what you'll see is that the stores that were closest to the ones that it closed had higher crime incidents in all but one case. So we have data on 21 stores. Only one store that closed had higher crime than the one that it kept open nearby.
She says that the stores they kept open had higher crime incidents than the ones they closed. Therefore, Target is misleading and blaming the closures on crime. They repeat the claim that Target was being dishonest in the report. There is just one problem with the explanation Target gave for closing stores. The locations it shuttered generally saw fewer reported crimes than others it chose to keep open nearby. So there you have it. And then they even have the metrics right here of the ones they closed and the incident reports of the ones they kept open. So at first glance, this all seems very convincing. It appears as though Target was lying about the reasons they closed their stores, blaming it on violence and crime, when in reality, they were just underperforming. This is what it appears like unless you look at the actual methodology that CNBC used to conduct this investigation. When analyzing 911 call logs and other crime data for this report, CNBC included in its tally only incidents that led to an arrest, police report or log, or incidents that police said they responded to and handled. That is what this entire report is based on. Phone calls to 911. So unless Target called the police for literally every single time an item was stolen out of a store, it did not show up in CNBC's methodology. The percentage of thefts that actually get phone calls to 911 or police incidents is rather small. So they're using a tiny sample size of data that's also very hazy. They're trying to sift through this data and drawing big conclusions from it that Target lied. Target's not going to call the police every single time an item is shoplifted from their store. If they did that, the police would literally be sitting in Target every single day because there are items stolen from Targets every single day. Shrink happens as a result of theft. They realize it when it shows up in the numbers of missing inventory. So the fact that CNBC would conduct this study with this incredibly faulty methodology and then insinuate that the Target CEO is lying is completely ridiculous, and they should be called out for it. Another thing I find ridiculous about this report is that they are looking at crime incidents not benchmarked for the amount of traffic or population or anything else. It's just the total crime incident. Good reporting would have crime rates, not crime incidents. Incidents is a singular total number of crimes without any context or benchmark. It'd be like saying that Disneyland, the entire park, has more crime incidents than your local Wendy's. Well, of course it does. It's much bigger. It has tons more visitors than your local Wendy's. This is why when you look at the amount of crime a city has, you do it on a per capita basis, because some cities have more people in it than others. And of course, bigger cities are going to have more crime incidents than smaller ones. That's not helpful. In this report, we can see the same thing. They're looking at the total amount of crime incidents at these locations without saying how many people actually go to these locations. Maybe this Greenwich location sees 10 times the volume of customers as this one. If that's the case, if this one has a lot more visitors on a per customer basis, it could actually be a lot safer than this one. So I'm not sure what the motive is here for CNBC, but if you're going to go after the Target CEO and insinuate that he's been lying or deceiving, you better do so with better methodology than what you showed in this report. Relying solely on 911 calls for retail theft is ridiculous in the first place, and reporting crime on a total incident basis instead of on a per customer rate is ridiculous as well. Maybe we'll see better data and methodology in the future, but so far this is entirely inconclusive. That's all for this time. Hope you enjoyed. See you in the next one.